Hey everyone! Welcome back to the channel. Today, we're going to dive into an important topic for all you real estate enthusiasts out there: choosing the right entity for your real estate investments. But before we jump into that, let's quickly review the 3 types of income in real estate. You might remember them from one of our earlier videos. Take a moment to think about it. The first type of income is active income, which involves actively participating in real estate activities, like flipping houses. The second type is passive income, which comes from rental properties. And finally, we have interest income, which includes earnings from loans or mortgages. Today, we'll focus on the S Corp, which is a great option for those looking to generate active income, particularly from flipping houses. Imagine you're flipping a house. You buy it, renovate it, and sell it for a profit. That active income should flow through an S corporation. Now, you might be wondering, when should I set up an S Corp? And what about rental properties? Well, it depends on your specific goals. If you're primarily focused on flipping houses, you'll want to start by setting up an S corporation. On the other hand, if your main strategy involves buying and holding rental properties, an LLC is the way to go. Of course, some of you might be doing both simultaneously, and that's great too. You can have both an S Corp and an LLC operating side by side, each handling its own tax returns. Let's simplify it further with a couple of examples. Imagine you're flipping houses. You close a property, renovate it, and sell it within a few months. That short-term income should go through your S corporation. On the other hand, if you're purchasing a property with the intention of renting it out for an extended period, that long-term income should be directed to your LLC. Now, let's talk about the benefits of the S corporation. Just like an LLC, an S Corp provides excellent asset protection. It creates a legal separation between your personal assets and your real estate ventures, safeguarding your personal wealth from potential lawsuits. The corporate veil of an S Corp is just as powerful as that of an LLC. You might be thinking, why do I need both an LLC and an S Corp if they offer similar asset protection? Well, here's the key difference: taxation. An S Corp and an LLC are taxed differently. For flipping properties and generating short-term income, the tax advantages lean towards the S corporation. On the other hand, for long-term investments and passive income, the LLC offers more favorable tax treatment. We're diving into the topic of S corporations, their tax implications, and how they can benefit us as real estate professionals. So, let's break it down in simple terms for easy understanding. First off, living in America or abroad, you can qualify for an S Corp, but there are certain criteria to meet. As an American citizen or a green card holder, you need to spend approximately 183 days in the country to become a shareholder of an S corporation. It's a bit complicated, so consulting with an attorney is advisable. However, even if you live internationally, you can still qualify for an S Corp if you spend a significant amount of time in America. On the flip side, if you spend no time in America, getting an S Corp might not be possible, but check the rules in your own country. Now, let's talk about how an LLC, limited liability company, is taxed. In an LLC, all the money it makes is subject to federal income tax, which is paid to the IRS. If your state has state income tax, you'll need to pay that too. Additionally, there's another tax called self-employment tax or figure, which is currently set at 15.3%. However, if you're in states like Nevada, Washington, Texas, Florida, or other states without state income tax, you'll be exempt from that, but federal income tax still applies. For those residing in states like California, Oregon, or Colorado, state income tax will be applicable. Now, here's where the S Corp comes in and dominates. In an LLC, the full 15.3% self-employment tax applies to your net income. However, with an S Corp, you have the advantage of paying yourself in 2 ways: salary and K-1 distribution. Your salary needs to be reasonable, and the remaining income can be distributed as a K1 distribution. Let's simplify it with an example. Imagine your net income is $100,000. In an LLC, you'd have to pay the full 15.3% self-employment tax, amounting to $15,300. But in an S Corp, you pay yourself a salary and a K1 distribution. Only the portion you pay yourself as a salary is subject to the 15.3% tax, while the K1 distribution is not. Now, to be legally compliant and avoid tax fraud, the general recommendation is to allocate around 30% of your net income to salary and the remaining 70% to K1 distribution. So, let's crunch the numbers. If you paid yourself $100,000 in an LLC, you'd be paying $15,300 in taxes. However, with an S Corp, if you paid yourself a $30,000 salary and took the remaining $70,000 as a K1 distribution, you'd only pay the 15.3% tax on the $30,000 salary. This means your total tax payment would be just under $5,000, resulting in a savings of $10,710. To put it into perspective, let's consider a hypothetical business scenario where you flipped 4 houses, making $25,000 in profit on each and totaling $100,000 in net earnings. If you operated under an LLC, you'd pay $15,305 in taxes. However, if you structured it as an S Corp, following the salary and K1 distribution strategy, your tax payment would be around $4,790, giving you a significant savings of $10,210. Now, let's briefly touch upon another advantage of an S corporation when it comes to flipping properties. Due to the higher tax savings it offers, an S Corp is a great choice for flipping houses. However, if you're dealing with rental properties, it's generally recommended to use an LLC for better asset protection. I understand that this information might feel overwhelming, so I encourage you to pause the video, rewind, and rewatch it if needed. Take your time to fully grasp the concepts and implications because this knowledge can make a significant difference in your real estate journey. I hope you found this video helpful, and I appreciate you tuning in. If you have any questions or need further clarification, feel free to drop them in the comments section below. Don't forget to like this video, subscribe to the channel for more valuable content, and hit that notification bell to stay updated. Thank you for being a part of our community, and until next time, happy investing. Let's wrap this up with a straightforward example. Imagine you're flipping a house, and it takes around 6 months to complete the project. Any profits you make from this short-term endeavor should go through your S corporation. However, if you decide to purchase a property and hold onto it for several years, generating rental income, that long-term income should be directed to your LLC. Remember, it's crucial to protect your personal assets by structuring your real estate investments through entities like the S Corp or LLC. This separation helps minimize your personal liability and safeguards your hard-earned wealth. If you found this information valuable and easy to understand, don't forget to give it a thumbs up and subscribe to the channel for more original content.